Everybody knows the impact that we've seen in both the oil and the gasoline markets because of the conflict in the Middle East. But what we've seen over the past 2 days is that we're getting some concern from central bank officials, specifically some very hawkish comments coming out of the leading central banks around the world. It is Thursday, March the 19th, and this is Markets with Megan. If you like this podcast, subscribe, hit the alarm bell, share it with your friends, family, or colleagues. But we're here to break down some of the headlines that we've gotten from whether it's economic data or, in this specific instance, central bank chiefs and what it's doing and why it's impacting the market. So we're seeing that energy prices continue to rise today. That has everything to do with just the broadening conflict that we have in the Middle East, as well as really no imminent solution here. So we're hovering around $100 a barrel of oil. We've been like this for a couple weeks now. Now, remember, the concern about the economic growth specifically relies around how long that we continue around $100 a barrel. If this continues for a prolonged period of time, it can have a negative impact on economic growth. But for now, we are looking at the fact that we do have a very favorable tax season right now as far as refunds going out. It could help cushion some of that for consumers, but we are approaching April, and that will end up subsiding for consumers. Now, where this is filtering into the central bank's view is because everyone's worried about inflation now. Yesterday, the Federal Reserve Chairman Jerome Powell came out, left interest rates unchanged, and their comments were very hawkish out of the committee meeting. Powell is very concerned about higher energy prices and that they will push up inflation. He's not as concerned about the labor market anymore, and that he sees a series of shocks, whether it's been tariffs or oil prices, that has interrupted their inflation progress. They think the current stance is appropriate, but when you read into the headlines or listen to the press conference, they're not open. They're not completely against raising interest rates this year. The futures market now has priced out any interest rate cuts for this year. But then we also had the ECB President Christine Lagarde, Bank of England. Both of these central banks are looking at raising rates this year because of the inflation pressures, specifically around this rise in Brent oil and crude oil. We've seen the biggest impacts here in the fixed income markets, 2-year yields specifically. The U.S. 2-year is at a 7-month high at about a 3.9%. But if you go over to England, the 2-year gilt is up the highest we've seen in over a year at 4.4%. The one thing that we are seeing as well is that break-even levels, or those inflation expectations, these continue to skyrocket. So there is a lot of concern in the near term that this isn't going to end. 2-year break-even levels here in the U.S. are now at the highest level we've seen since 2022 at a 5.2%. So what that's telling us is that the market is pricing in an expectation of about 5% average inflation over the next 2 years. This is definitely something that's taking some of the steam out of the equity markets. We're seeing equities across the board weaker, but we're also seeing profit taking in some of those there's areas of the market that have been the most loved. If you look at gold, gold has broken some technical levels now. It's down below its 50-day moving average. It's sitting at its 100-day moving average, and then the next technical level could have it fall as much as to down around 4,100. So we're seeing some profit taking. Some flight to quality a little bit going into the U.S. dollar, which has done better since this with the Iran war. But we are seeing some just overall risk sentiment being taken off the table here in the markets. Now, we have often said that we don't think the Fed has the flexibility to cut interest rates the way the market was expecting, and that was regardless of the war. So we think the only change here is that the Fed is most likely not going to cut interest rates. We'll continue to monitor how this filters into inflation. And again, this all depends on how long oil prices stay this high. If they continue to persist at these levels for the next couple of months, then we may actually be on that camp where they might have to tweak by raising interest rates. We're not there quite yet, but it is on our horizon, and we're keeping an eye on that. That's all we have today. If you want a history of our podcast, you can go to marketswithmegan.fm. Thank you.